This chart tracks two identical starting balances of $10,000 over 30 years. We have two people, both 28 years old, saving the exact same amount of money. Their financial outcomes by the time they hit retirement will look like they lived in two different economies. The first person takes the default path, putting their $10,000 into a standard savings account, paying roughly 0.5% in interest. 30 years of waiting results in a line that practically flatlines. That 10 grand earns a meager $1,600 in profit over 3 entire decades. The second person puts their money into a simple, diversified market index. Over the same 30 years, that identical $10,000 curves sharply upward. Without requiring any special insider access, the final balance hits $174,000. This divergence in wealth stems entirely from how that capital was stored. One path allowed the money to sit dormant, while the other utilized the compounding growth of the broader economy. To understand how that gap happens, we have to look at the primary business of a traditional bank: lending. Banks generate wealth by using the deposits on their balance sheets as the raw material for their own revenue. When you deposit $1, the bank essentially rents it from you for a 0.5% interest rate. They then immediately lend that same dollar back out to other customers for mortgages, car loans, or credit cards at 7, 12, or even 20% interest. The bank keeps the massive spread between what they pay you and what they charge everyone else. By capturing this interest rate spread on millions of accounts, the scale becomes staggering. Last year, the top 4 banks in the United States generated over $100 billion in combined net profit. That profit is the direct result of borrowing your money for almost nothing and selling it to others for a premium. The tools to bypass this interest spread system have been public knowledge for decades. High-yield accounts and index funds allow individuals to keep that profit for themselves, yet the majority of capital remains in low-yield traditional accounts. This banking model thrives on the fact that most people leave their money dormant. The system relies on our continued participation to keep those profit margins high. Why do intelligent people leave their cash in accounts that lose purchasing power to inflation every single year? The answer lies in status quo bias. The human brain naturally defaults to whatever feels familiar. We often choose a known, suboptimal option over an unfamiliar one that is mathematically superior. Banks spend billions to trigger this feeling of familiarity. Frictionless mobile apps, imposing stone architecture, and prominent FDIC insurance seals are all designed to signal absolute security. This engineered comfort effectively paralyzes your capital. When you feel safe, you are less likely to move your money, which keeps it available for the bank to lend out at a profit. The perceived safety of a traditional account acts as a psychological trap. It ensures your money stays still so the bank can put it to work. Breaking this cycle starts with moving to a high-yield savings account. These accounts, mostly offered by online banks, carry the same FDIC protection and liquidity as a traditional branch. Because these banks avoid the overhead of physical buildings, they can pay interest rates closer to 4 or 5%, returning that value to the depositor. For long-term growth, the S&P 500 Index Fund serves as the primary engine. This fund is a single container holding fractional pieces of the 500 largest U.S. corporations. Investing in an index fund removes the bank as a middleman. Instead of letting a financial institution keep the profit, you capture the historical growth directly. Moving to these tools corrects a basic structural inefficiency in how you save. It simply ensures that you, rather than a bank, receive the yield your capital generates. To maximize this shift, you can use a specific legal framework to shield that wealth: the Roth IRA. Within a Roth IRA, you contribute money that has already been taxed. That capital then compounds for decades. When you eventually withdraw those funds, every dollar of growth is entirely exempt from taxes. Contributing $500 a month to a standard account for 30 years results in a significant tax bill on your profits. That same contribution inside a Roth IRA can grow into over $1 million that you keep in its entirety. Congress specifically designed this framework to encourage long-term, independent wealth building. It is a deliberate piece of the tax code created so that the Internal Revenue Service cannot touch your compound growth during retirement. Utilizing a Roth IRA turns simple savings into a strategic tax defense. It ensures that the growth your money earns stays with you. Leaving capital in a 0.5% account acts as an invisible tax, paid directly to the institution holding it. The primary difference between those who build significant wealth and those who don't is rarely the size of their first paycheck. The real variable is accurate information acting upon time. Reclaiming that yield requires 3 steps. First, move your emergency fund to a high-yield savings account. Second, open a Roth IRA. Third, automate monthly contributions into a broad market index fund. These wealth-building frameworks were established by the U.S. Capitol to be used by the public. The legal architecture is already in place for you to move your capital out of the bank's interest spread and into your own accounts. You now have the information required to reclaim your financial agency. You can begin breaking the banking system's rental